Well, happy Thursday afternoon, everybody. I appreciate you tuning back in. I want to say off the top that I appreciate very much the phone calls and the text messages, the questions and messages, both public and private, on Facebook and whatnot. I'm glad that it's helping you. I'm more than happy to do this. I love talking about these things. I love talking about the housing market, thinking about where we're going to be here, not just in the short term, but long term. If this, then that type of scenarios. Keep in mind, however, though, a couple things. One, there are people much, much smarter than myself, both in finance and economics out there, that they are arguing with themselves as far as where we're going, because this is all theoretic, uh, all theoretically based. I mean, it's we haven't been here before. We'll never be here again. Our whole system is a theory. The second thing is that my filter is, and my perspective of things that are going on are filtered through the lens of what you can call Austrian economics. I've mentioned it before. People have asked me what that means. Austrians believe that basically, if you write a check, you better have the cash in your account to cover that. Austrians believe that the really only prudent way to grow an economy is through saving and investing, versus the Keynesian model is more of, well, let's just print, we'll consume, and let's not worry about the production side of things. Let's just worry about consumption side, and then we can print our way and inflate our way to prosperity. And it's unstable. It's always been unstable. It doesn't matter what you call it or how many tweaks or what have you have been made to the system. A Keynesian model based on credit expansion and fostering an environment of consumption is always going to lead to ruin, and not just because of the fiscal policies behind it, but also because of the inherent moral hazard within the system that leads to a decay within society itself. So remember that I'm taking the things that I'm listening to and I'm witnessing, I'm seeing, both play out in the markets, and then whatever the Fed has to say, I try to listen to it as much as I can. And I relate that, like, okay, so from an Austrian standpoint, does this make any sense? And you know what? Not much of what's going on is making any sense. I think we're in trouble. I think at the end of the day, probably in my lifetime, we're going to see a very hard collapse. Not just because of what the Fed is doing to the dollar, although that's certainly not helping, but because also, you look at countries like Egypt are joining the BRICS nations. Mexico just recently applied to join up with the BRICS nations. And BRICS is a conglomeration, and it's expanded over the years. You have the Shanghai Corporation too in there, but you have Brazil and Russia and India and China that make up these core countries that have years ago, into the decades now, decided to trade with one another and try to get off of the American Federal Reserve note, aka the American dollar, aka the petrodollar, and start trading in their own currencies. And I feel like, from what I've read, they're at the very, not necessarily beginning stages, but they're at the end stages of kind of forming their system with one another, but at the beginning stages of trying to get out of the dollar hegemony. And when that happens, when that decoupling happens, in terms of us being the Federal Reserve note being the reserve currency of the world, when we finally do decouple from that and the petrodollar, it's going to be a very, very, very bad day in America, especially if we keep up with our trade imbalances and keep increasing tensions across the world. It's not going to be a good day. But then the next question becomes, well, who is really running the show then, and why are they doing what they're doing? And this is the point. This is what I'm trying to tell you, is that I'm the things that I see happening. I'm going, well, it doesn't need to happen that way. I mean, for instance, if the Fed could have started raising rates years ago, actually, and the pandemic was just a mechanism to make another excuse to inflate the currency even more and debase the dollar. Um, but they could have raised rates years ago. Not to mention the fact that, talking about what the Fed does. Well, why don't if you want to fight inflation, well, make sure banks have a 25% reserves in their system. take money out, because as of today, they don't have to hold any in reserves. Now you can find out which banks are probably healthy and which aren't by maybe even just asking, hey, what's your passive savings rate? And if you go talk to a bank and they say, well, it's 0.75% or 1.25%, and you talk to another bank and say, well, we're at 3.5% for passive savings, that bank has probably got liquidity problems because they're willing to pay out a higher rate just to get your deposit in. See what I'm saying? So you could fundamentally figure out on your own which local banks are solvent and which aren't, because that actually is what's happening to Signature Bank currently, and what happened to SVB. They became insolvent. And they became insolvent, as I mentioned before, because of higher rates, because most of the debt at those banks and with our government, it's short duration, it's short, at least with the banks that are failing, it's short term notes. And you can't refinance, you can't go through all of these years with 0% rates at the Fed and then expect when the Fed jumps up to 5% that things are going to be rosy. You have to roll that debt over, and now you're paying 5% over. Now you're paying a 6% note versus a 1%. That's a huge hit. And so these things are probably going to continue as long as the Fed continues to raise rates. But we're seeing fissures, we're seeing cracks in the facade of what this system is and how this unfolds and why it unfolds. I have my theories. I have my theories as to why all this is happening, but none of it is good. And so it also makes it hard for me to talk about housing when underpinning all of this is the idea that they're doing this for a reason, and that reason is for more control. Money moves the world, folks. Money makes everything move. And so why wouldn't they want to control this? I mean, they got you all anyway. Everybody's in debt. We have the savings, as I mentioned, I said this before, like you could take all the wealth of everybody in the country and you still wouldn't come even close to paying off the debt that's outstanding. Now you can sell off your assets. I'm not even going to get into that argument, but there's mathematically we can't, because for every dollar that's created, there's 10 lent out. So the debt that's created, debasing the system, debasing your currency, will never ever be repaid back. It can't. Mathematically, it's impossible. So they've done what they can to print over it, but inside of all of these things, and this is what I want to touch on so I don't make this video too long, but someone asked me why I don't use inflation in my oil inventory and interest rates. My three things that I keep telling people to keep an eye on in terms of the housing market is because I don't need inflation. First of all, CPI is a BS calculation. How they calculated it, I don't agree with. It's not a true inflation number. It's not what we say to people. The core number isn't true in terms of what we're actually living through and what we're seeing on a daily basis and what we're spending. So the two things that I can judge how the market's going to react without even needing to know what inflation is oil, because oil is the main driver. It's the main currency. The petrodollar is the main currency. Oil is the main currency. I don't know how many times I can say this. Oil is what drives the world, because the dollar is priced, because oil is priced in the dollar, and we're the reserve currency. We have such a great benefit. But as I say, when that stops, when Saudi Arabia, and they've already hinted at, we're not going to be their bestest trading partner anymore. This is going to be a bad day for us. So oil has an inverse. If you look back at 2012, for instance, I wrote a couple notes down here. We were paying $3.62 at the pump. Around that same time frame, we were paying about $150 a barrel. In 2008, we were paying $180 a barrel at 3.25. But that became on the heels of the financial collapse. So not necessarily an organic type of relationship there between gas at the pump versus gas, at 180 a barrel. But I'm illustrating a point of how they hide inflation. And so if you look at today, it's about $3 on average is what we're paying, but we're only spending $75 a barrel. So that's how they can hide inflation within the system itself. We're getting charged almost as much as we were when the price per barrel was 180, but yet it's less than half that. So there you go. They can hide inflation that way. Then there's other ways that they do it too. But it is a hidden tax on people. And if you listen to Austrian economics, people say that it is a hidden tax on people. So look at CPI, and why I said July. I mentioned that in the other video, but July of last year is when it kind of started to go out of control. And so I do believe that we'll see CPI come down, and of course the pundits and the propagandists on the mainstream media will do everything they can to make sure that, oh, the Fed did their job, they came in and saved the day. That number is going to be so meaningless when it comes out to the downside. Now, if CPI comes out and it's 7% or 8%, even 6%, that's going to be a very telling sign of where we're at in this country. Because if you look at February of 21, 22, and 23, those 3 years, I may have mentioned this before, but it's 22.4% inflation. So did your income go up 22.4 or 5 or 6 or 23.8% versus 3 years ago? Probably not. So nominally, so you're literally worth less today, and you're making less today than you did last year. You're actually making less today than you did 2 years ago. So how does that make you feel, that they're stealing your wealth from you vis-a-vis inflation? And these are all things that are controllable. These are all things that people who say we can't use gold and silver, well, because we can control inflation so much better. Really? I'm doing a bang up job on controlling it right now, aren't you? So moving forward, how can, I mentioned in the past too about keeping an eye on the DXY, the DXY, which is the dollar strength relative to every other currency in the world. That's going to tell you a lot as well. Because the weaker our dollar is, the higher we're going to pay for products being shipped here anyway. Which, by the way, is how we've had an income tax before. We never had an income tax, permanent income tax, prior to 1913. And it took them a few years to get people to start voluntarily paying it, because people didn't want to pay it right away. They're like, well, why? We've never had this, and this is BS, I'm not paying this. Eventually they did. But how we funded government, how we funded military especially, was through imports, tariffs, and those types of taxes. So why not just go back to that? And I'm going to do a different video on that, because the whole thing is a flat tax or consumption tax is basically a regressive tax, which is not. And I'll explain that in a different video. But in terms of inflation, I mentioned them having requirements. Well, they could have tightened credit a long time ago too. But see, here's the problem. 70% of our economy is consumption driven. So if they tighten credit and they don't expand the debt-based system, and people take out less debt, and there's people see spending less, well, then how are we going to grow our economy? So there is no real desire to tighten credit. We may see that moving forward. That's going to be an interesting thing. I'm not going to give an indication as to what I believe is going to happen in that regard yet. But if they do tighten credit, we'll see. It's not going to have a positive impact. The other thing that I want to mention, another way to reduce inflation. So if they make a pivot here and they stop raising rates, they stop raising interest rates, and they still have to attack inflation. Let's say July comes in at 7.1% and August comes in at 6.8% inflation. That really, we're in a world of hurt, because we're talking about 30% inflation over 3 years, or over 4 years. That's going to have devastating effects. So the other thing they can do, if they don't want to continue to raise rates, and keep in mind, in a recession, which we're definitely heading into one. I know there's people out there that think that we're not, but we will. A way to fight inflation is to reduce interest rates. I mean, that's the one or not inflation, but a recession, and that's the one tool in the toolkit of the Fed. It's the biggest one to use. So they could reduce rates, but that, again, now we're talking about a hyperinflationary aspect to this whole thing, especially if we do that. Um, Other countries around the world are going to say, well, we're not interested in your bonds anymore or your debt because you guys are completely unstable. Um, so I don't think that they're necessarily going to reduce rates. What I do think they'll do is probably hold off on hiking them, and then they'll start to attack the jobs market, because if you have less people working, that's less people vying for the same product, especially if our trade imbalances start to work themselves out, as well as the relationships in general. Not to mention if our supply chain, it appears as if it's coming back and things are heading in the right direction that way. So if supply chains, if the issues there ease up and go back to a quasi-normal state, they can just attack the jobs market and reduce inflation that way. So just something to think about. And keep in mind too, the tech industry has done that. If they cut jobs anymore and reduce anymore, they're going to start cutting into bone. And I think you're going to see corporations and businesses outside of the tech industry starting to, they may advertise for jobs, but it's just all going to be window dressings. They're not actively seeking employment. And then once the hiring freezes stop, then you'll have the all out firings of people and layoffs and mass layoffs. And so that is what I see happening more so than a reduction of interest rates, just because that has less of a world impact versus just us suffering here at home. So anyway, I'll leave it at that. If you guys have specific questions that you want me to address, more than happy, because it's almost easier taking something that you guys want to hear versus me coming up with something. But anyway, I appreciate you tuning in. Comments, suggestions, how to improve, always helpful. And God bless you guys. Appreciate it. Take care. We'll talk soon.